in the silver market. Look, we're 10 days away from the first notice day of delivery for the March silver contract. 150 million ounces that would need to get sourced, right? The registered silver category, that is the available silver backing the contracts, available to deliver, is about 90 million ounces. If demand for delivery spikes, COMEX has two options: either drain registered inventory very fast, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. When metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver 50 million ounces at 10 bucks, you just made $500 million. That VAT tax is the responsibility of the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks. Are they doing it to get out along with stand for delivery? Are they doing it to extricate themselves from these stupid short positions that used to work? Don't let go. Don't sell your metal.
Silver closed out at $76, and right at the moment, 70. We're in the low 70s still. So it's a not significant move since the beginning of the year. However, we all know that there was a dramatic run up, a sharpest decline in history perhaps, and then now showing some support here. Can you give people your view of the underlying fundamentals and what you look for going forward in the silver market?
Well, look, I mean, the drawdown was crazy, no question about it. You know, you look at a few things that have precipitated these drawdowns. You talk about the Bloomberg headline that ran cover for the paper smash, as far as I'm concerned, where they said Russia was going to jump back on the dollar standard. And this precipitated forced index selling, and along with the margin hikes and the dumps by the algos or the algorithms that run everything. And when they start to see selling begets sellings. And in a fraction of a second, you saw $3.5 trillion erased. And then quietly, the report comes out that says Russia is on record saying they're not going back to the dollar standard. Yet that day, Bloomberg pumps the opposite narrative, and that's the news. You know, that's the positioning news that we get. It's almost like they're running cover for it.
Sometimes the biggest market moves start with headlines, not fundamentals. As Andy Schectman suggests here, algorithmic trading and margin hikes amplified a narrative shock that erased roughly $3.5 trillion in market value within seconds. A reminder of how fragile liquidity can be in modern markets. When machines react faster than humans, volatility becomes structural, not emotional. Investors should remember the March 2020 crash showed similar forced selling dynamics driven by liquidity stress rather than long-term fundamentals. Andy Schectman warns this type of volatility often precedes deeper institutional repositioning.
But when you talk about what's happening right now in the silver market, look, we're 10 days away from the first notice day of delivery for the March silver contract. And I think people really need to understand what this means. As of Friday, there was 58,770 contracts that were left open interest, as it's called, that could stand for delivery. Each contract is 5,000 ounces, so that's 294 million ounces open interest right now for the March contract. A bunch of it has rolled to the May contract, because there was about 400 million ounces a week ago. So about 100 million ounces have rolled to May, which is the next big delivery month, not April, it's May, and that's normal, right? But it's still really very huge that we have 300 million ounces open this close to first notice. So I think what I take away from that is not a COMEX default, but even half of the open interest actually decided to stand for delivery. You're talking 150 million ounces that would need to get sourced, right? The problem with that is that the registered silver category, that is the available silver backing the contracts available to deliver is about 90 million ounces, right? So, do the math. If demand for delivery spikes...
Open interest numbers often reveal more than price charts ever will. Andy Schectman highlights a critical imbalance, roughly 294 million ounces in potential delivery demand versus only about 90 million ounces registered for delivery, a ratio that signals structural tightness rather than speculation. This doesn't imply a COMEX default, but it does show how leverage dominates commodity futures markets. Historically, delivery participation is small, yet even a 20 to 30% delivery rate could strain inventories. Andy Schectman believes the next delivery cycle could expose how thin real supply truly is.
COMEX has two options: either drain registered inventory very fast, which would be, I guess, a very serious drawdown, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. They will try and get people to roll to May by incentivizing cash settlements with a premium. Anything to keep anything to keep metal from leaving. And in my opinion, this is how the stress shows up. It's not in price, but it's in the delivery mechanisms and the delivery mechanics. And when the paper claims tower over the deliverable silver, I think the market is calm until it isn't. And so I think really what you're looking at is even a portion of this stands for delivery. 20% stands for delivery. You're talking, 60 million ounces of the 90 million. This is a problem. And so I think that's, to me, the biggest issue right now. What I'm watching is we'll see what happens over the next 10 days. At the same time, you still have this big $10 premium in Shanghai over the Western price, that this arbitrage is not going away.
Market stress rarely appears first in price. It shows up in plumbing. Andy Schectman is pointing to delivery mechanics, where incentives like cash settlement premiums and exchange for physical deals signal tight supply conditions beneath stable pricing. A $10 Shanghai premium suggests regional demand is pulling physical metal away from Western exchanges, creating a geographic liquidity imbalance. Similar delivery stress appeared briefly during the March 2020 metal squeeze. Andy Schectman believes delivery participation in the next 10 days could reveal whether this tightness is temporary or structural.
They're continuing to incentivize the people here in the West who have the ability to buy cheap, $75 or whatever, and sell it for $85 in China. A lot of people say, well, what about the difference in price is the tax. The VAT tax, right? Not tariffs, that there's a VAT tax, which is true, but it's not true, right? These are people who are not quite understanding the mechanics. The VAT tax is really there, but it's the responsibility of the recipient, because when metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver 50 million ounces at $10, you just made $500 million. That VAT tax is the responsibility of the recipient when it leaves the Shanghai exchange. So it's not paid until it leaves. If it stays there, there is no tax. So in other words, that arbitrage is significant enough at this point for a $10 premium plus like a 13 or 14 or 15% tax. They don't care. They want the metal. And so this is all, I think, noise. You have to see the big picture.
Global price gaps often reveal where real demand lives. Andy Schectman explains that a $10 Shanghai premium, even with VAT considerations, still creates strong arbitrage incentives, meaning physical silver is flowing toward Asia, where buyers are willing to pay more. That's similar to how energy markets reprice regionally during supply shocks. When physical demand ignores tax friction, it signals strategic accumulation rather than speculation. Andy Schectman sees this east-west price divergence as evidence that global price discovery may slowly be shifting away from Western exchanges.
You have to relax, see the big picture, understand it for what it truly truly is. And I think, yes, the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks that trade credit, not real metal. And real demand is showing up in Shanghai. And price discovery is shifting there. It's leaving London. It's leaving New York. And as long as the Western paper market stays disconnected to Shanghai like it is now, the physical silver will keep getting pulled out of the West and sent to where it's valued. And look, the scary part, it's even getting tight in Shanghai with premiums starting to blow out. And I think that's why, to me, the forwards and the futures are starting to feel almost undeliverable for a lot of people. This is why you're seeing backwardation, where the market makers are having a hard time sourcing metal. They can't hedge easily. Their exit becomes the move, maybe, right? And getting out. And I think that's what you see every time they smash the hell out of it.
Price discovery rarely shifts quietly between continents. Andy Schectman points to a structural shift where physical demand in Shanghai is beginning to challenge pricing dominance historically held by London and New York markets. Backwardation in metals markets is rare and usually signals immediate supply tightness, something last seen briefly during the 2020 liquidity crisis. If physical silver continues migrating east, Western paper pricing power weakens over time. Andy Schectman suggests these sudden price drops may reflect positioning stress rather than collapsing demand.
Are they doing it to get out along with stand for delivery? Are they doing it to extricate themselves from these stupid short positions that used to work before this was all, I think, figured out? Where, there are some very sophisticated traders around the globe, as I've been saying since 2020 on your show. The central banks have figured it out of the global south. Stand for delivery, slowly. Don't do it too fast. Everyone says, why don't they just throw trillions of dollars at? Because you kill yourself. You cut off your nose to spite your face. They've been masterful at draining the exchanges all around the world. And that slow, insidious, little by little part, people can't handle. It's too monotonous. It's too slow. It's a nothing burger. But as you can see, we're getting to the point where they're running out of available silver to deliver. And that, to me, is all you need to see, on top of who's been standing for delivery every single month over month, for billions and billions and billions of dollars. They don't do this for the hell of it. What you see right now is just the volatility meant to throw the rest of us off the scent, off the trail, and join the highest influx into global U.S. equities in history.
Big structural changes in markets often look boring until they suddenly matter. Andy Schectman argues central banks and global institutions may be gradually accumulating physical metals through delivery channels rather than large visible purchases. That slow accumulation strategy mirrors how sovereign wealth funds quietly build positions over years instead of months. Meanwhile, record inflows into US equities suggest capital is still chasing performance rather than hedging risk. Andy Schectman believes this slow drain of exchange inventories could eventually collide with investor complacency.
They want the rest of us in the pen with the rest of the sheep. At the same time, you got billionaire David Einhorn. I don't know if you saw that article, but he thinks that gold is well on its way to becoming the world's ultimate reserve asset. This is a guy that runs one of the biggest hedge funds in the world, and he's saying that it's already replacing treasuries, as we've talked about for the last several years, as central banks' reserve asset, because the confidence in this system, both fiscal and macro outlook, is getting worse. And, when you look at China telling their banks to scale back treasury exposure, it's a signal to me that the shift for gold is far greater than the shift is for treasuries. They're selling them. And we've seen almost 900 tons bought in 2025 by the central banks, which is huge. So anyways, bottom line is, with both gold and silver, the fundamentals couldn't be stronger, but the volatility, I think, will continue to knock those who don't have strong fingertips off the back of the bull, who wants to take as few of you along for the ride as possible. All bull markets do that.
Reserve asset transitions don't happen in headlines, they happen in balance sheets. Andy Schectman highlights central bank gold purchases approaching 900 tons in 2025, continuing a multi-year accumulation trend that reflects declining confidence in sovereign debt markets. When hedge fund managers like David Einhorn discuss gold replacing treasuries, it signals institutional concern about long-term fiscal sustainability. Treasury demand shifts matter because bond markets still anchor global liquidity pricing. Andy Schectman believes volatility in metals may reflect this slow reserve asset transition playing out beneath markets.
Don't let go. Don't sell your metal. That's all I can tell you is that this is not over, not even close. This is the volatility one would expect in a shift like this. And big money, big stakes, big volatility.
Along the way, something that may be counterintuitive has happened, and that is even as silver was being taken off the exchanges, supplies running dry, we had this huge backlog of junk silver and 90 less than 3/9 fine silver. There have been some explanations about a silver refining backlog. People who purchased 90% silver over the past couple of years are often asking us, well, why did I buy this if this is something that nobody wants and the premiums are going through the floor and that sort of thing? Can you talk to us, give us again a seasoned perspective of what's going on and what kind of a market, where the tide is at right now and where you expect that it will have to return to?
I've never seen a market like this. Never, ever. I mean, let's go back to the pandemic.
Supply bottlenecks can create confusing signals for investors. Andy Schectman describes a paradox where exchange inventories tighten while retail silver products like junk coins face weak premiums due to refining backlogs. This resembles commodity supply chain distortions seen during the 2020 to 2022 pandemic period, when logistics, not demand, drove price dislocations. Investors often mistake temporary processing constraints for collapsing value. Andy Schectman suggests once refining capacity normalizes, premiums could reconnect with underlying physical demand trends.
Premiums on junk, we were paying $9 over spot for 4 years. Anyone that would sell us as much as they would sell us, we would pay $9 over spot. I've never seen a market like this, and it's not just junk silver, although that's been hit relatively hard on the buy side. It's all of the items with the exception maybe of Silver Eagles. I've never seen anything like it. Let's talk about it a little bit. In an effort, I think, by the CME group to, which is the COMEX, to knock the speculators off their perch, they raised margins significantly. So normally we'll have 2 or 3 million ounces of silver in our warehouse, and we will hedge it ounce for ounce so that we're market neutral. We'll sell the equivalent of what we have in our warehouse on paper. So one goes up, one goes down. We've talked about this a lot. So you're market neutral with your inventory. If a week or two before Christmas, it was about $16,000 to hedge 5,000 ounce contract, somewhere in that neighborhood. Now it's about $50,000 to hedge a 5,000 ounce contract. And gold is about $40-some thousand to hedge a 100 ounce contract.
Margin policy rarely makes headlines, but it quietly determines who survives volatile markets. As Andy Schectman explains here, the jump from roughly $16,000 to $50,000 per silver contract is not speculation control. It's liquidity pressure. That's more than a 200% increase in hedging costs within weeks, forcing dealers to tie up capital instead of moving inventory. The CME's decision before Christmas effectively tightened financial conditions inside the metals trade, similar to how Fed rate hikes slow credit markets. Investors should recognize this as structural friction, not simple price volatility. And what Andy Schectman warns next explains why supply bottlenecks can appear suddenly.
You have to have that in your margin account. And as long as the market doesn't move against you, it stays there. Well, you know, if you're not a big company with 50 million or more that you can park in a margin account, you're not having a big inventory, first and foremost. The cost of running this business because of things like that has become exponentially higher. with insurance. Insurance say, well, metals have gone way up, and how are you going to protect that and ensure that within the vault and all, coinciding with the stupid margin increases to the nth degree to knock the speculators up. So you are a refiner. So companies like mine have big enough bankrolls to buy this stuff and stockpile and hang on to it, right? And hedge it. The cost of hedging just went way up. But if you're a mid-sized company or a small-sized company and you don't hedge, you offload it right away. Well, with the volatility we've seen in the market where, $1 moves used to be a lot. Now we're seeing huge moves.
Rising costs in metals markets aren't coming from price alone. They're coming from survival math. Andy Schectman points out that only firms with tens of millions in liquidity can now maintain inventory safely. Insurance premiums rising alongside metal prices create a second layer of pressure, squeezing smaller refiners and dealers out of the supply chain. When daily silver moves expand from $1 swings to multi-dollar volatility, unhedged inventory becomes existential risk for smaller operators. This quietly concentrates market power into fewer hands, something long-term investors should notice. Andy Schectman suggests this consolidation pressure may reshape dealer supply dynamics next.
You have to be way back of spot if you're not hedging it, because you could take in $100,000 worth of stuff and it moves $10 an ounce and the next day and you're way down. Well, if you're taking large amounts in, you go out of business. So the small mid-sized companies who aren't hedging, well, they have to be way back of spot because of this environment. Normally they would give it to the refiner and get spot or, a hair under, whatever, but now the refiners won't take it because the refiners have to hedge theirs. So, if the refiners take in $50 million worth of product, they'll hedge $50 million worth of product on COMEX, right? Market neutral. Well, it takes time to break down the doré, to break down the junk silver, melt it down into pure silver, into shot, and then refine it into bars and rounds, and or the flatware where the knives the blade is stainless steel, the handle is plaster, a little bit of sterling silver around the handle. It takes time to break that down.
Volatility is turning inventory into a liability instead of an asset. Andy Schectman highlights that a $10 per ounce move on $100,000 worth of silver can erase margins overnight for unhedged firms. Refiners hedging tens of millions on COMEX face timing risk because processing scrap silver into deliverable product can take weeks. This creates a temporary liquidity freeze where sellers accept below spot pricing simply to avoid price exposure. Historically, similar bottlenecks appeared during March 2020 when physical supply chains stalled despite strong demand. Andy Schectman next connects this refining delay to margin calls across the industry.
Snap off the blade and break the silver off the handle, and all it's labor intensive and it takes time. Well, for 2 months, the price of silver was going up so fast and the margin requirements so fast. All the refiners got margin called. And they're like, we can't do this. We take in any more, we're going to go out of business. We're getting margin called on our short position to offset our inventory, but we can't even melt the stuff down yet. We're getting margin called because of it. The entire industry has been gummed up because of margin increases in particular. And it has reverberated through the entire industry, largely because the refiners, which would provide a great source of liquidity to the industry, aren't anymore. They're not taking any business. And so when you look at the increase in costs on those that use margin, and hedge rather, or the risk for those that don't, it's created an environment that no one has ever seen before. Now, I don't think this will last.
Liquidity crises rarely start with investors. They start inside supply chains. Andy Schectman describes refiners being margin called while holding unprocessed silver inventory, a timing mismatch between paper hedges and physical production. When refiners stop accepting material, a key liquidity provider disappears from the ecosystem, similar to banks pulling back lending during credit stress. 2 months of rapid silver price increases combined with rising margin requirements created a mechanical squeeze, not a demand collapse. These operational frictions can distort prices temporarily. confusing investors watching only spot charts. Andy Schectman believes the next phase depends on liquidity returning to refiners.
I just think that this is an environment that it's kind of an outlier. I would not sell junk silver right now. It's the best value period. Buy it at spot. It is the best value I've ever seen. And remember, in a period of great stress, 2020 through 2024, we would have paid you $9 to $10 over spot for any amount of junk silver you would sell. So it was the best performing asset in silver other than Silver Eagles for 4 years. It's just the fluidity and craziness of the times that we live in, which, after what we've lived through the last 4 or 5 years, nothing should surprise you anymore. This is not a new rule. I think this is an exception to an old rule. And hang tight. This will all, once it all clears through the system, once the system ungums up, I think we'll be back to normal premiums on all of this stuff, junk silver included.
Sometimes the best opportunity appears when market plumbing temporarily breaks. Andy Schectman argues junk silver trading near spot is historically unusual after premiums reached $9 to $10 between 2020 and 2024. That 4-year stretch showed strong retail demand for recognizable fractional silver during crisis periods, like pandemic stimulus and inflation spikes. If refining bottlenecks normalize, premiums could revert simply due to restored liquidity rather than new investor demand. For portfolio builders, this becomes a timing question about market structure rather than metal fundamentals.